Graham, just by the index, Stephan, just made a video on the next stock market collapse and 6 ways to make money during the collapse. Or more just like the 6 things to kind of think about. Now, I completely agree with his overall investment strategy of buying the index, not trying to time the market, dollar cost averaging in, and really overall similar allocations on US stock market and how we think about gold and things like that. And he's great at consuming what's going on in the markets and the economy and sharing that. So definitely shout out to Graham. Definitely go ahead and follow his channel. So what I want to talk about in this video are some of the things that Graham didn't mention inside his video that I think might be helpful for you if you're an investor, if you're worried about the next stock market collapse. Because here's the thing, there will be another stock market collapse. There will be. It's just a matter of time. Now, every 1.87 years, there's a stock market correction. Correction implies a basically 10% decrease from the high. And then there could be bear markets, which are 20% decreases from the high. And this is typical. Overall, the word correction is a great word for it because it's kind of human nature to overshoot on things, to get overhyped on things, and then for things to correct. Kind of similar to how people buy on the rumors and sell the news. It's natural for us to kind of overextend and then try to correct. Same thing goes with both sides, right? Usually we panic and sell way more than we should have, and therefore things should be higher. So, but over the last 10 years, there's been basically 11 corrections, and every 7 to 10 years, there's this bear market with an average loss of around 33%. So Graham talks about all these things, and one thing that I kind of want to start with here is that these corrections don't just happen. Now, a correction is usually from like an overinflation of kind of something that was artificially propped up, and then something happens, right? But a bear market or something that triggers a crash, that's something that is usually going to be triggered by something. It gets triggered, right? So usually what happens is the market is overly propped up, is overly hyped, and it takes something to really trigger the huge decline. So this could be, for right now, we're getting some jobs data, inflation numbers, Q2 earnings report. That's something that is really important to look at, especially when we're looking at recovery plays, things that have recovered super well, but are probably not going to do super well, in my opinion, moving forward. I think that, the profit that things have been maybe overhyped on the recovery plays. We'll see where things are. And it also has to do with the future, right? So if companies start showing great Q2 earnings, but then they say forward looking, we're not so confident, that might trigger something. The also important thing to know about these kind of triggers is we always base things year over year. So what that means is if we see a decline in profits, usually the headline will be basing it off of a year ago. And so when we saw this massive boost, as certain companies like, say, Netflix or DoorDash or Peloton saw this surge from people buying during COVID, well, can we expect similar profits moving forward? And my guess is probably that's not sustainable, right? Those things that were super propped up because of COVID, because of people being at home, those are unlikely to, in my opinion, sustain that type of growth. So there's also news like the Delta variant that could cause a trigger if we see kind of this COVID 2.0 trend of more lockdowns and things like that. Now, before I go further and kind of talk about what is maybe the most important aspect of looking at the stock market crashes, please subscribe if you are looking to build your wealth. Everything on this channel is about building and growing your net worth, so make sure to subscribe for that. We're also going to do the first 1,000 subscribers of this channel are going to get perks for life, so go ahead and subscribe. You're going to be part of that OG first 1,000. So with the stock market crashes, no one can predict these things. No one can predict how long they are, when they're going to happen, how severe they're going to happen. But something that I think is helpful is to look at the history. Now, Graham does this right here. I have a version of that right here. And what this kind of helps you do is put things in perspective as to how long things might take for them to recover. And as you see here, the bull markets in green compared to the red markets that are bearish, well, the green markets seem to last longer, right? And the drawdowns could be pretty dramatic, right? We have a 48% drawdown right here, 33%. So you have Black Monday, you got the 2000 bubble, you've got all of these things that have happened, and these all from, as you can see, some sort of trigger, some war, some terrorist attack, the dot-com bubble, global financial crisis, you got the housing market, you have Brexit, and of course you got COVID. So what triggers these things is something that is usually a black swan. You don't know what is going to happen, and something happens and it triggers this event. But as you zoom out, you're going to see an overall trend. And that is that even if you bought at the very worst time, like the global financial crisis right here, it took around 5 years for you to be back at normal. And so that's what I want to talk about in this video, is basically creating an allocation that you can live with. So I am a firm believer that if you're a long-term investor, you should be a bit more aggressive, right? And what the aggressive portfolio means is that you have a higher stock allocation. So this is an example from Fidelity. This is the US stocks, this kind of dark blue. This green is foreign stocks, international holdings. So right here, we're at, let's say, a 70% allocation of stocks and then a 30% in bonds. Now, the most important thing for you is deciding how much you are willing to go down. Okay, so how much are you willing to go down? The worst 12-month return, if you have an allocation that's conservative, with the blue being bonds, so 50% being bonds, and then also this green, which is like short-term bonds as well. So if you are like 75% bonds, well, the worst 12 months is a negative 17%. You might think, oh, that sucks, because look at how great the market has been all these years. Negative 17 sounds terrible. But here's the thing. If you were in the aggressive one, it would be down 52.9%. So this is a much bigger number. And you have to be cool with these kind of drawdowns. Overall, being more aggressive is going to have a stronger overall return. As you can see here, the best 20-year return, 15% compared to 10% if you had 75% bonds compared to if you had pretty much 75% stocks. The balance is somewhere in the middle. Now, as someone young, if you're watching this, you're 25 to 35 most likely, click like if you are. If that's the case, you have the ability to weather the storms of negative times. There's not been a time in history that you could have bought where 20 years later you would be negative. There's not a time in history. So if you think of it like that, you want to make sure that you are investing with what you're cool to watch that thing dip by. And it might not be for everyone. Like, I might recommend, although I can't say I recommend anything, can't say financial advice, but if I was talking to my mother or talking to my friend, and let's say someone had a long time horizon, like 40 years, right? If you're 20 and you want to just chill out when you're 60 and take out that money, you got 40 years to do that, you have a lot of time. So the chances are your portfolio will perform the best if you have a very aggressive portfolio, high stock allocation. But if you're emotional, if you're someone that can't handle when things take a dip, then I might recommend, even if you have a long, I can't say the word recommend, I would tell myself that if I was emotional, I might need to show lower losses, because people who have really aggressive portfolios but aren't willing to watch a negative 52% hit, they might do the worst thing at the worst time, which is usually to panic and to sell. So the worst time to do that is the time that is most enticing for people, right? The time when things are crashing, that's when people panic, sell. And if you can't do that, if you can't tell yourself, I'm cool with just doing nothing, I don't need the cash in the short term, I will try my best to hold on to it and do nothing, then I'm always going to come out on top within a 20-year span. I think this is like the last 100 years or something. And the worst 20-year span, if I bought in the very worst time in history, I would be at 3% annualized return, right? 3% annualized return, which is better than the bank. And that's slightly better than inflation, maybe. But you got to make sure that you're willing to hang on when things go bad. So you can't time the market, because this is a $10,000 investment invested in the S&P 500. If you invested $10,000 January 1st, 1980, and you stayed invested the entire time, you'd be at 952,000. That's crazy, right? If you missed just the 5 best days, you'd be at 590,000. Like if you pulled out and you missed those 5 best days, you'd have a negative 38%. If you missed the best 10 days, yada, yada. If you missed the best 50 days, you'd be at 68,000. And I know you might be thinking, oh, how am I going to miss like the best 10 days? The funny thing is that most people do miss the best 10 days when they start playing the market, because what happens? They panic when things drop tremendously, but those are often the days that things can shoot up the most. So the biggest returns are obviously, they happen to be sometimes after the biggest hardships, right? Here's the subsequent 5-year returns. Great Depression, 367% after the Great Depression, right? For 5 years. Great return. I would love that. See, the thing with timing the market is you have to be right twice, okay? You have to be right at the very top, like right here, and then you have to be right when things, when to buy back in. You have to be right when you sell, and you have to be right when you buy back in. Now, I had someone who, I promise you, I kid you not, told me I should sell everything and go to bonds. And you want to know when they told me? This exact little low, I think it was March 13th, on the exact day, said, I think I'm going to sell everything. I think you should sell everything. And even if he got, halfway right, and said that halfway, there's a huge chance that he would have not caught it on the way back up, right? What happens when people catch things is they will sell, and then as things go up and up and up past the part that they sold, they'll go, no, it's going to go down. It's going to go down. I was right. I need to hold off from buying. And there's this mental not wanting to lose out and confirm that you were wrong issue there. And so you have to be right twice, which is pretty much incredibly difficult. So in this, invest aggressively if you have a long time horizon and you're willing to just keep it in there no matter what. If you do not have that kind of risk tolerance, and you know yourself, and you know you're going to start trading, and you know you're going to start doing stuff, then I recommend maybe thinking, again, not recommendations, it's investment education. I recommend you kind of think that, am I willing to take the biggest drops? And am I going to stay on the same path and not change my strategy? Not think I am smart enough to have a timing strategy. Any kind of strategy you have besides your asset allocation and besides dollar cost averaging in, that is basically timing the market. So don't kid yourself. This is AI. Talk to you soon.